Looking at the quarterly results of Dixon Tech, we can see that there has been a 52% jump in net revenue. Net revenue is coming out to be 4658 crores, and there is a jump of 20.7% in net profit. When we compare it with the Bloomberg estimates, we can see that there has been a miss when it comes to net revenue, and also there is a miss when it comes to the profit numbers. Talking about the revenue split of the company, we can see that company is working in different segments like consumer electronics, which contributes to 25%, lighting products, which contributes to 12%, home appliances, which contributes to 7%, mobile and EMS, which contributes to 60%, and security system, which contributes to 3%. Company is also planning to have a capex of around 300 to 400 crores over the next 2 years, funded by external debt. In addition, it is estimated to have debt repayment obligation of around 90 crores in FY25 and FY26. Further, the company is one of the largest LED TV manufacturer in India, and it services more than 35% of India's requirement. The company operates on two models, namely original equipment manufacturer and original designing manufacturer. Company has shown a great sales and profit growth in last 3, 5 and 10 years. We can see the growth rate in higher double digits, and stock price CAGR is beating the profit growth, which means that there has been a re-rating in terms of its PE. From this graph, we can see that the company is trading at a PE of around 137 and is higher than its long-term averages. So despite the fact that company has grown quite a bit in last few years, the stock price CAGR has been greater, which makes it expensive compared to its long-term averages. Looking at its technicals, company is trading in a channel, and since the profit numbers have been good for the company, we can expect the company to show a decent performance in short term. If it comes down to around 7200, which is the lower end of its range, it can be a good bet for short term. Next company we'll check out is Mankind Pharma, and as we see in the results, there has been a jump of 19% when it comes to revenue. Current revenue for the company is 2441 crores. In net profit, company has shown the jump of 62.3%. Current net profit is 477 crores, which means that there has been a margin expansion. Estimates which company has was 2437 crores for revenue and 387 crores for net profit, which means that company has been able to meet its expectations when it comes to revenue, and there has been a beat in terms of net profit. Looking at the technicals, this company also is trading in a range and is currently near its short-term support. So this can be a good buy if we want to bet for this company for a short term, since there has been a good increase in net profits. The next company which we are going to discuss is Clean Science. As we can see from the results, there has been a 5% increase in sales and 13% drop in net profit for this company. If we look at the quarter-on-quarter numbers, we can see that there has been an improvement in terms of sales as well as in profits. In chemical sector, mostly the companies are not showing good performance in last few quarters, but it is expected that all these companies will start showing recovery from next quarter onwards. Talking about company's business, we can see that the product in which company operates in are market leaders when it comes to India, and it among the top players when it comes to complete world. Company is also leader in few of the FMCG chemicals. As we can see, Fomap, Anisole are few of the chemicals from FMCG sector in which company is a market leader. Looking at its historical performance, we can see that the sales growth is in high double digit. It's 15% and 16% for 5 or 3 years. Profit growth is 20% and 7% for 5 and 3 years. And the reason, as we discussed, that the chemical sector is not performing well in few quarters, but the companies which are operating in this sector sometimes show profit growth and sales growth of around 100% as well. So when that comes, then these numbers will look different. Because of drop in profit numbers, we see that the P ratio of the company has also dropped and it's currently trading just below its long-term averages. Company is currently trading at its long-term support, so it can be a good bet for long term since the company's business is solid. It also is a leader in various segments. When the performance turns up, then we'll see a good profit growth and hence a good stock market returns as well for the stock.